Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is David Grumhaus, President and Chief Investment Officer of Duff and Phelps Investment Management, to discuss global infrastructure and REITs, certainly two areas in focus as we work through the recovery. David, it's great to have you with us. Welcome to Trade Talks.
It's great to be here, Jill. Thanks very much for having me.
How did real estate and global listed infrastructure perform in the first half of 2021?
Coming into the year, we felt pretty good about both sectors after a tough 2020. Clearly, REITs have been the standout. U.S. REITs are up about 19% through May. Global REITs are up about 15%, both easily surpassing the market. From a REIT perspective, there were two things that we really thought were positives coming into the year. One, were the balance sheets were in much better shape than they were in previous downturns. And then secondly, REITs were trading at a big discount to private NAV, and we knew there was a lot of private money on the sidelines. And so both of these things have really played out. And we've seen the deep value REITs, so the traditional REITs that maybe had gotten hit the most by COVID, the lodging, the office, the malls really perform. And the growth names have also continued. On the listed infrastructure side, it's been a little bit more muted. Listed infrastructure is up about 8% year to date. We've seen a really nice recovery in midstream energy. The wireless towers have continued to do well. It's been more muted for the airports and the toll roads. Most of those are in Europe, and the recovery obviously there has been slower than in the US. And then, the big laggard has been the utilities, which are only up about 3% year to date.
What's your outlook for the sectors for the second half of the year?
We'd say both three things about both sectors. Number one, we think the deep value names, so whether it's the malls and the lodging names or the airports and the toll roads, we think those names will continue to recover. Those names are still down from the beginning of 2020, versus an overall market which is up probably 35%. Number two, inflation, obviously big question in the market right now. Is it transitory? Is it going to stick around? We're not willing to make a call on that, but we will say that we think both of these sectors work really well in an inflationary environment, and we think it makes sense for investors to have exposure. Finally, taxes, again, unclear what's going to happen with corporate taxes here in the US, but both the REITs and the UTs are advantaged in that it really won't affect their earnings if taxes go up. And obviously that's not the case with the rest of the market.
And when we take a look at REITs, just delving down into them a little bit deeper, any specific thoughts around residential versus commercial? Certainly we've seen in housing, it's gotten so beyond the means of first-time home buyers. Could that potentially be a tailwind for, let's say, apartment REITs?
We feel pretty good about where the REIT market is going. The momentum's been good there. Obviously, you mentioned single family. It's been really, really hot, but we are starting to see apartments definitely come back. I think you point to the shortages in housing and the demand for it. And we also think that people are moving back into the cities a little bit. And obviously with the economic growth, that's good for the apartment REITs. So we feel good about the overall sector. We're seeing a lot of interest in it, both institutionally and retail, and we think that will continue.
And to wrap up here, how about global listed infrastructure?
We feel positive here. We think listed infrastructure could be the REITs of the second half. We expect very good momentum to continue on midstream energy. Obviously, the commodity prices are a really good tailwind there. When we look at the airports and toll roads, we think that recovery trade is happening in Europe, and that those names should really start to see some gains. I think the big question mark is probably the utilities, and we've seen reflexive selling in the utilities here as people want to be in the more cyclical names, but we think people are missing that the utility business is really running very well, and that these utilities offer very transparent long-term 5 to 7% growth. I would also say about the utilities, they're trading at a 15-year low relative valuation versus the S&P 500. We also think they can be huge beneficiaries of the energy transition story. We're very big believers of the energy transition. We think this is really being driven by sort of this trifecta of very strong global support, very strong customer support, both from individuals as well as from corporations. And then also the fact that we're seeing, really good improvements on the cost curves, whether you're talking wind or solar or even batteries. And we think that this is a multi-decade story, and we think the market is underappreciating how the utilities are going to benefit from this.
All right, David, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.